Welcome to our in-depth exploration of the Capital Requirements Regulation 2013 and the Capital Requirements Directive 2013. These two legislative pieces are central to the regulatory framework governing financial institutions within the European Union. The Capital Requirements Regulation, commonly referred to as CRR, and the Credit Institutions Directive, often abbreviated to CRD4, were both established in 2013. Together, they form a cornerstone of EU banking regulation aimed at ensuring the resilience and stability of credit institutions. So why were CRR and CRD4 introduced? The financial crisis of 2007 to 2008 exposed significant weaknesses within the financial sector globally. These regulations were part of the Basel III framework, developed to strengthen regulation, supervision, and risk management within the banking sector. One major concept introduced by CRR is the minimum capital requirement. Essentially, this mandates that banks hold a certain minimum amount of capital relative to their risk-weighted assets. To better understand this, let's break it down with an example. Suppose Bank A has a Tier 1 capital of 1 billion euros and Tier 2 capital of 500 million euros. Its total risk-weighted assets amount to 10 billion euros. Using our formula, Bank A's capital ratio would be. This ratio is critical as it determines the ability of the bank to withstand financial stress. A higher ratio means the bank has more capital relative to its risk-weighted assets, making it more resilient. Another key component of CRR is the liquidity coverage ratio, LCR. The LCR is designed to ensure that banks have an adequate stock of unencumbered high-quality liquid assets, HQLA, to meet their liquidity needs for a 30-calendar-day liquidity stress scenario. Here's an example to illustrate the LCR. Suppose a bank holds high-quality liquid assets amounting to 200 million euros, and its total expected cash outflows for the next 30 days are 170 million euros. The LCR must be at least 100%, meaning banks should have enough liquid assets to cover their potential outflows. In our example, the LCR is 118%, indicating the bank is well prepared for financial distress. Now let's turn our attention to the Credit Institutions Directive 2013, or CRD4. This directive complements the CRR by setting out specific conditions for capital buffers, which are additional reserves banks must hold on top of their minimum capital requirements. One of the noteworthy capital buffers under CRD4 is the Capital Conservation Buffer. This buffer ensures that banks build up a capital surplus during economic upturns that can be drawn upon during periods of stress. For most banks, this is set at 2.5% of their total risk-weighted assets. For example, if a bank has risk-weighted assets amounting to 10 billion euros, it must hold an additional 250 million euros, 2.5% of 10 billion euros, in capital as a conservation buffer. Another crucial buffer under CRD4 is the counter-cyclical capital buffer. This buffer is designed to counteract excessive credit growth by requiring banks to hold additional capital during periods of high economic growth. Its exact percentage varies depending on national regulators' assessments of market conditions. CRD4 also establishes rules around governance, remuneration policies, and policies regarding capital adequacy. Such comprehensive regulation helps ensure that banks operate prudently and maintain stability across the financial system. Let's take a real-world case to see how these regulations apply. Consider the European banking sector from 2015 to 2020. The capital ratios of banks significantly improved as a response to CRR and CRD4. Data from this period indicate that the average Common Equity Tier 1 (CET1) ratio for major EU banks rose from around 11% in 2015 to over 14% by 2020. Based on this analysis, entities within the banking sector managed to build a more robust capital structure. This progress not only reflects compliance with regulatory standards, but also signifies increased resilience to financial crises. Let's pause here for a moment to go over some questions that you might have. One common question is, how does CRR and CRD4 ensure capital adequacy in banks? Answer: these regulations establish minimum capital requirements, such as Tier 1 and Tier 2 capital, and introduce capital buffers like the capital conservation and countercyclical buffers. These measures ensure that banks have sufficient capital to absorb losses during financial stress. Another question you might be wondering is, what is the significance of the liquidity coverage ratio? Answer: the LCR ensures that banks hold enough high-quality liquid assets to cope with a 30-day financial stress scenario. This reduces the likelihood of liquidity shortfalls, thereby maintaining trust and stability in the banking sector. To conclude, CRR and CRD4 are essential to maintaining the integrity and stability of the European financial sector. They provide a regulatory framework that ensures banks are well capitalized, govern their operations prudently, and are prepared to withstand financial crises. Thank you for joining us on this comprehensive exploration of the Capital Requirements Regulation 2013 and Credit Institutions Directive 2013. Stay tuned for more finance tutorials that demystify complex financial regulations.